car makers, German car makers in particular, because they are huge manufacturers in the US. BMW and Daimler in particular have very large footprints in the US. BMW makes all its SUVs in the US, and they are then shipped globally. So they are really affected by this. They have been affected by this previously because they also ship cars the other way. They have manufacturing sites in China. So this is an industry that is very, very deeply entrenched in sort of the global streams of goods, and this is something that's very difficult for them to then accommodate these tariffs that land on their feet.
Benedict, there are a lot of questions about supply chains and imports and exports. I guess I'm trying to figure out how much China is an importer of foreign vehicles at a time when they're trying to support their local businesses. In other words, how do you even parse out the effects, triangulate the effects on these automakers at a time when China is buying fewer vehicles and is trying to encourage local businesses anyway?
Yeah, they are certainly doing that, and you're seeing more and more car makers set up shop in China. Tesla is building a new factory there. It's not up and running yet, but at some point that is their plan. So you are seeing more and more car makers go local, or even, as you say, local Chinese manufacturers becoming bigger. It's very difficult for car makers to just sort of pack up and move. These are huge facilities that they've built over many years. They've cost them billions. It's not like software. You can just sort of print it out somewhere else or produce it somewhere else. So for these car makers, they're very static. So they're sort of caught between the global movement of their goods, but them having a very static base. And there are the sub-suppliers tied into this. So packing up, very difficult for them to do. But China's certainly a market that they have to serve.
So Benedict, you mentioned earlier that it's interesting that a lot of the European automakers, particularly BMW, has factories, production facilities in the United States. Have those companies talked at all about how they would ever, if it's even possible, relocate some of the production out of the U.S. to perhaps just get out of the way of some of these tariffs?
We're not at that point yet. No, BMW put out a short statement today after this announcement out of China saying that they believe in the global free movement of goods. They believe in a sort of essentially a tariff-free world. We are not yet at a breaking point. What they might do is raise prices for their cars and see how that goes down with the consumer. There might come a point where BMW has to rethink its footprint, but their involvement in the US, their location in the US is so big that moving that out is their single biggest factory globally, the one they have in Spartanburg, that moving that out is going to come at a huge counter cost, and that's something that at this point they're not willing to consider.
Benedict, I'm glad you brought up the idea that prices may increase for consumers. I'm wondering how much, just sort of to build on that idea, how much this will continue to push the idea of an SUV, a larger car, a more expensive car, as the one of choice, at least for the automakers, to sell, because they can charge more for it, and it's been clear that people are willing to pay the extra money.
Yes, that's absolutely right. So we have seen over the last couple of years SUVs become the car of choice for most people. It's a category that, frankly, over here in Europe, a decade ago was really a niche phenomenon, and these days you see a lot of SUVs in the streets. And those, as you say, are cars that command a healthy premium, but we see the industry trying to move into the smaller, into the more nimble niche, the small compact cars, electric cars. Those don't have the kind of they don't have the kind of premium that an SUV has. So as they try and roll the costs over to consumers, we might actually see them cling on to these profitable cars longer than they'd really want to.
So Benedict, what if you could just give us a sense of kind of the financial ability, the health of some of the global auto companies to withstand what could be an extended trade war? It's really only 10 years ago during the financial crisis when a lot of these companies were really teetering on the edge and they needed government assistance. Give us a sense of kind of how you think they're prepared globally to withstand a potential trade war.
Financially, they are still doing okay. If you look at the Germans in particular, the biggest company in this space is Volkswagen. They have less of a big footprint in the US. They are fairly large over here in Germany, obviously, but also in China. So they're not as badly affected, and they are actually kicking out a lot of cash at the moment. The diesel crisis is somewhat behind them, and they are doing well again. BMW and Daimler are in a slightly more difficult position right now. Daimler's had a string of profit warnings. BMW's just essentially kicked out its CEO and has switched to somebody else. So these are companies that aren't really firing on all cylinders, and so for them to absorb these kinds of hits, that's going to be much harder. And if it gets worse for them, we might actually start seeing some consolidation in the market. We might see some car companies speaking to others. It will ultimately turn into a survival of the fittest, and the biggest in this case.
So, Benedict, just to wrap up and sort of put a bow on this, I'm wondering, what are you looking for in terms of a tit for tat, any kind of development on the trade front in the rhetoric that could indicate whether there's a softening or a potential escalation even further?
There probably will be an escalation before we see any kind of softening. We sort of saw the Chinese retaliation today. It will be interesting to see how the US responds to this. Europe is in a very difficult position here because Germany as a country can't sort of single-handedly do any kind of retaliatory steps here. It's always the European concert that has to move here, and that is very difficult because you have a lot of different players in this. You have the French, the Brits, the Germans, and they're all trying to navigate this. So for Europe to have a sort of coordinated response is going to be very difficult. They're trying, but so far they don't really speak with one voice. So really the eyes are on the US versus China, and the Europeans, in particular the Germans, are sort of caught in that battle.
Benedict Kamel, thank you so much for being with us. Benedict Kamel is a managing editor focusing on global business, joining us from Berlin right now. The S&P auto subsector is down nearly 2% in the wake of the news of China planning to impose additional tariffs on cars starting on September 1st. So definitely creating a market response.
All right, let's get a look at the national headlines right now with Michael Barr. Michael.
Thank you very much, Paul. Thank you, Lisa. Billionaire industrialist David Koch, who, with his older brother Charles, transformed American politics by pouring their riches into conservative causes, has died. Charles Koch announced the death today, saying, "It is with a heavy heart that I now must inform you of David's death." David Koch, who lived in New York City, was the Libertarian Party's vice presidential candidate in 1980. He was a generous donor to conservative political causes, as well as educational, medical, and cultural groups. In 2014, David Koch talked about his life to ABC.
I have a value system that my father instilled in me, and I've been following his beliefs and his value system all my life.
The Koch brothers founded the anti-tax small government group Americans for Prosperity. David Koch was 79. There's late word Massachusetts Representative Seth Moulton plans to exit the Democratic presidential primary race today. He becomes the second 2020 candidate, joining Jay Inslee to drop out this week as the field narrows. Moulton focused on mental health treatment after revealing his own struggles as a combat veteran. President Trump leaves Washington tonight for the G7 summit in France. It will also be the first one-on-one meeting between Trump and new British Prime Minister Boris Johnson. Global news 24 hours a day on air and at TikTok, on Twitter, powered by more than 2,700 journalists and analysts in more than 120 countries. I'm Michael Barr. This is Bloomberg. Paul, Lisa.
Michael Barr, thank you so much. Continued weakness in the markets, but coming off the lows a little bit. The S&P down about 12.5, the Dow down an even 100 points here. So as we wait from comments, Lisa, from Chairman Powell at 10 a.m. or certainly the release of his statement at 10 a.m. Wall Street time. So the market, sitting on edge here a little bit.
Well, trying to figure out what the Fed can actually do to counter the increasing trade tensions between the U.S. and China in particular. And this comes at a time when the leaders of 7 nations are about to meet in France for the G7 meetings. At a time when we're hearing from a number of Fed officials, and Jay Powell is going to set the tone for the next few meetings, just moments away from that, where we get his speech. Very interesting day. Clearly, the knee-jerk reaction is to risk off bond yields lower, and it is sort of a slowing growth kind of environment that people are looking at, with an increasing risk, by most accounts, of recession. We are now going to hear from Philadelphia Fed President Patrick Harker. He's in Jackson Hole, Wyoming, for Kansas City Fed's annual symposium, sitting down with Bloomberg's own Michael McKee, talking about some of these issues, the Fed's reaction function in light of trade tensions. Let's head to Mike McKee.
Thank you very much. And again, welcome to all of our viewers and listeners on Bloomberg Television and radio worldwide. And thank you to Patrick Harker for joining us this morning on a chilly morning here. Yep. We're only a few minutes away from Jay Powell's speech, and we can't preempt him. Right. But yesterday you said you'd be happy to leave rates where they are if the economy stays about where it is. Right. But this morning we had further evidence from China that we may see the trade war extend for quite some time. Policy works with long and variable lags, as they always say. So when you look out 8 months to a year, can you say you would want to stay on hold, or do you need to act now to get ahead of something?
No, I think right now we are where we need to be. That said, there are clearly these downside risks to the economy, and I think we would have to act as appropriate if those come to fruition, or even look like they're coming to fruition. The biggest concern I have right now is when you talk to business leaders, nobody I talk to says that the cost of capital is inhibiting business investment. And that has been the drag on the economy right now, is business investment, not the consumer. The consumer has been the hero of the American economy. So if that's true, right, that business investment is not being held back by the cost of capital, us reducing interest rates will have no effect. What's holding it back is the uncertainty around policy, particularly trade policy.
So is there anything for the Fed to do at this moment? Are you feeling pressure to be the savior of the economy because you're the only game in town?
So I think we have to act as appropriate when we see the economy having a shock. I don't see that right now, so I don't think we need to act right now.
Do you anticipate, from what your business contacts are telling you, that the economy is going to deteriorate, or are they kind of on hold too?
A lot of them are on hold. I mean, it's perfectly reasonable if you're sitting in a board right now, a corporate board, not to make a big bet until some of this uncertainty resolves itself. It's an absolutely reasonable thing to do.
What are they telling you about their economic outlook? In the absence of trade wars, would they be expanding?
Yeah, what we hear is especially around manufacturing, right? If we had more certainty around manufacturing, particularly globally, I mean, there are clear global risks, but those export-led economies like Germany are facing large challenges right now because of this uncertainty. Yeah, if that resolved itself, I think people would be making those investments.
There's enough demand in the economy.
Yeah. Look at the consumer. The American consumer continues to buy.
Would the consumer be the last person, though, to feel the change? I mean, if you're waiting for retail sales to fall off, are you going to then get a signal it's too late?
No, but why is the consumer buying? Because the job market continues to be strong, right? The labor markets continue to be strong, and so household incomes continue to be strong.
Well, you've got a reaction function that has been based on the idea for decades of controlling inflation and keeping inflation down. Inflation's gone away as far as most people are concerned right now, and unemployment keeps going lower and lower. Do you need to change the way you look at the economy?
No, I think, look, inflation clearly is a conundrum. That is, we don't really understand why it's been low for so long. But it's not necessarily the case, and we see this around the world, that if you have a more accommodative monetary policy, you're going to suddenly move inflation. That's not happened in other countries. And so there's some underlying trends with the economy that are different today than before that we continue to try to understand. In that situation where there's uncertainty, I don't think we should move precipitously in either direction. I think we should stay the course and see how things unfold.
We do worry that Wall Street, or global Wall Street, as it were, might overreact to Fed rate cuts and misallocate capital.
Yes. I mean, one of the concerns is financial stability. That is, with rates going even lower, leverage rising. And that is a concern for the economy.
Do you see it anywhere yet?
A little bit in leverage lending, but it's something we need to keep. It's only something I'm watching. I wouldn't say it's a situation that warrants any action at this point.
One of the things that came out of the minutes this week was the idea that the Fed should be acting, at least some people on the committee think so, to try to bring inflation up.
Yeah.
Interest rates, though, were at zero for 7 years, didn't work.
Right.
So how much validity does that argument have anymore?
So again, I think there's some underlying trends with inflation. But if you look at the latest CPI print, it's moving in the right direction. We are moving around 2%. And we're close enough, in my mind, where I don't think we need to take action at this point.
Well, as the Fed continues its review, one of the issues that's come up is, do you let the economy run hot, let inflation run above target for a while to make up? How do you feel about that?
So, yeah, average inflation targeting of some form. So that's an appealing idea in theory. In practice, it's a little difficult because you are asking a future committee to act in a way that the current committee wants it to act, and that's very difficult.
But if you let that happen, do you worry that inflation could get out of control again? Or are you fairly sanguine about the prospects for prices?
So at this point, I don't see inflation running out of control in most scenarios. Of course, there are a few, but generally, no, I don't see that as a risk right now.
Well, then what is the Fed's reaction function going to be? What are you going to look at?
Yeah, so I can't speak for the Fed. I can only speak for myself. And again, I look at a strong labor market and rising wages, again, slowly, but rising wages, look at inflation. And one of the things we continue to factor in is the financial stability question.
Well, you look at the labor market and you see slowing hiring, still above the replacement rate. But is that because companies can't find workers or because they're getting more cautious?
I think a mix of the two, but what I hear more than they're getting cautious is they just can't find the people. And not just people, the skilled positions. We often focus on those. I was talking to a major home builder who said, I can't find people to carry bricks and sticks on the site, right? And so I'm limited in terms of how many homes I can build.
So is this about as good as it gets then?
I don't know. I mean, it's been surprising in a good way that we're bringing more people off the sidelines into the American economy. That's a good thing for the person and for the American economy. And I think there may be a little bit more to run, but probably not a lot more to run.
So have you changed your economic outlook based on the trade wars, based on what's happening?
Not yet. I mean, we have predicted going back to trend growth, 2% growth, with the employment numbers coming down to about 110,000 a month. No, we haven't changed that because the volatility in the policy itself is hard to predict and hard to put into any model.
Well, if you haven't changed your views, where do you think the proper setting for monetary policy is? Several participants in the Open Market Committee deliberations have told me you look at the Fed funds rate above the yield curve, and that just tells you you're too tight now.
I think we're about where we need to be in terms of, I think we're about neutral right now.
Do you think that it is a problem that we're going to see a slowing in financial conditions if a tightening of financial conditions if the current settings stay?
It's a risk, and it's a risk I'm monitoring, but right now I'm not forecasting that, no.
So you don't see the markets as disrupting at this point?
Well, there's a lot of volatility in the markets for sure, and the people watching know that.
But disrupting the path of the economy?
No, not at this point. I think the larger risk is this policy uncertainty, particularly trade uncertainty.
And there's nothing you can do about that?
And there's nothing. We need to react as appropriate to that, but no, we can't. We don't drive that policy.
Do you worry if you're trying to react that you're going to be too late?
Well, if I knew what it was, then we could plan. But right now, again, the volatility in the actual policy is too great for me to predict.
How hard is it for you to do your job on a daily basis, given the tweeted criticism of the Fed? And I don't mean in the room when you're making policy decisions, because every Fed person will tell you it doesn't affect us. But you go out and you talk to your constituents. Do you detect a change in attitude among people these days?
The main thing I hear when I'm out and about, and I was out and about in my district all summer meeting with people, is the concern that Fed independence is being threatened. I mean, everybody I talked to said that Fed, even though we're not perfect and we don't always make perfect decisions, that independence of the Federal Reserve is absolutely critical for the American economy.
You're not hearing people come up to you and say, you guys are the bad guys?
I don't hear much of that, no. In fact, all summer I didn't hear any of that.
How much of a threat do you think there is to the Fed independence? Is this more of a media creation than anything else?
No, I think we are a creature of Congress, and we are responsible to Congress, and so Congress could change the laws. I don't think that's in the foreseeable future, but we have to recognize that Congress has the absolute right to do that. But we need every day to earn the trust of the American people by acting on their behalf.
The last question is the same question I put to all of your colleagues, and that is, do you worry we can talk ourselves into recession?
Yeah, I mean, I think the lack of animal spirits, if that diminishes, that's real. I don't sense that is widespread right now. I think there are some concerns, particularly in manufacturing, although our last manufacturing business outlook survey out of Philadelphia was good. So while even across the board, manufacturing looks like it's weakening, there are pockets where it's still strong.
So you're optimistic about where we go from here?
I think I'm cautiously optimistic is the way I would say.
Well, what does cautiously optimistic mean? How much of a threat do you think there is?
Well, I think particularly if this policy uncertainty around trade gets worse, we would have to act as appropriate.
You keep using the same phrase that Jay Powell used at his news conferences and things like that.
Yeah.
You mean cutting rates at that point, even if you think it doesn't work?
Well, yeah, because if it starts to affect the consumer, right? So on the business side, I don't think that channel is not very strong. But if it starts to affect the consumer and consumer confidence, because the consumer is 70% of the economy, that would have a real impact. So if we could do something in a way that would restore confidence to the consumer and put a little bit more money in their pocket through refinancing or whatever, that would be a good thing.
You think they would respond then to lower interest rates?
People respond to refinancing their mortgages for sure.
Is there much of that left?
It depends on where the rates are, right?
All right. Pat Harker, thank you very much for the Philadelphia Fed. Thank you for joining us on Bloomberg Radio and television this morning. We'll send it back to you in New York.
That's Bloomberg's Michael McKee speaking with Philadelphia Fed President Patrick Harker as we await comments from Fed Chairman Powell from Jackson Hole, Wyoming, to get some thoughts on kind of what we've heard so far this morning from the regional Fed presidents and what we might hear from the Fed Chairman Powell. Let's bring in our good friend Carl Riccadonna, Chief U.S. Economist for Bloomberg Economics, joins us here in our Bloomberg Interactive Brokers studio. So, Carl, let's start with some of the conversations Michael McKee had with some of these regional Fed presidents. Any theme coming out for you from those folks?
Well, there's an ongoing discussion about the relevance of a yield curve inversion. And what we heard from Patrick Harker just a moment ago is he doesn't believe that's particularly of concern. He said we're at about neutral. We're where we need to be. We don't need to act now. He's cautiously optimistic based on the health of consumers. However, I think Mr. or Mrs. Market, as it were, would disagree with his assessment that we're at about neutral, because the inversion of the yield curve is a signal from the markets, the wisdom of crowds, if you believe in that, that the setting of interest rates is actually too high.
Are they going to say anything that we don't know? I mean, is Jay Powell going to say anything at all that's going to surprise the market?
Jay Powell doesn't want dramatic fireworks here. That's not going to help the Fed's goal or messaging. We really have to take it in the context. If the market was mispriced, then he might use the opportunity to reshape expectations. But markets are already looking for a rate cut in September, a rate cut in October, and are eyeing the possibility of a move in December as well. So if that's roughly the profile that he expects to follow, even if he doesn't say it explicitly, then he doesn't have a lot to do on the communications front. If he really is one and done, which certainly is not my belief, then he would need to come out with a much tougher tone today.
Because it seems like, it just as you framed it right there, that the market is, pricing in 2, perhaps 3 rate cuts this year. Anything, less than that in his language today, presumably would be a big disappointment to the risk asset.
Would be a disappointment to markets, and the Fed is not looking for any version of a reprise or a repeat of what happened in December of last year, when they tried to ignore what the markets were calling for and instead be a cheerleader for the economy. We saw that wasn't going to work last December, and Jay Powell is definitely conditioned by that experience, and he's not going to try to accomplish the same thing today. He can very much keep a number of rate cuts, whether it's 1 cut or 3 cuts or 4 cuts, into the realm of a mid-cycle adjustment, not the start of an easing cycle.
I think it's interesting. I remember years ago, people would say, don't fight the Fed. That was the mantra that really was the driving force for a lot of investing strategies. Now, is it perhaps the Fed's turn to say, don't fight the market?
Well, I think the Fed learned from Q4 not to fight the market, but also I think the adage of don't fight the Fed certainly applies. So Fed and markets are kind of drifting in the same direction as we see slowing global growth, slowing growth in the U.S. as well, and policy moving in a more accommodative direction.
So is that how the Fed wants to be perceived, that it is perhaps more attuned to market movements than not?
The Fed wants to absolutely be perceived as being sensitive to market developments. However, they do not like the notion that there's a Powell put in the markets, or that they're being dictated by market developments. That being said, to the extent that market developments can impact the economic outlook, then the Fed is beholden to market developments.
I have to wonder how much the Fed is simply boosting asset prices and not affecting the entire real economy. I mean, that's been a persistent theme. By keeping rates low and lowering them further, it disproportionately helps people who are wealthier and doesn't really draw more people in off the sidelines.
That is a problem. However, as you lower financing costs, then businesses are more likely to make investments. Households are more likely to take advantage of low interest rates. So it's a blunt instrument, absolutely. And one of the problems with the blunt instrument is that you don't get the surgical precision that you might like to have by helping certain lower income demographics and things of that nature, but it's simply not how monetary policy works in a macro economy type of framework. And so there are those side effects. And the Fed is very cautious to the creation of financial stability risks from keeping rates very low relative to growth dynamics. So it's an insurance policy in some regard against slower growth, but it does create increased risk that we could have frothiness in certain financial markets. Now, the Fed has confidence with the counter-cyclical capital buffer and also with tighter bank regulation that hopefully they can avoid that. But in the past, these types of mid-cycle adjustments have created to some degree of financial stability. It's not a guarantee that it comes about, but it's something they're keeping an eye on, and I suspect that's a major motivation for the dissents we've seen from the Rosengrens and Georges at the Fed.
How closely do you think the ECB is going to be following what the Fed does today, or Chairman Powell says today?
Oh, I think they'll be watching his signaling quite closely, although I would argue that Chair Powell is really, in a sense, responding to what the ECB signaled before him. So it's a little bit of a chicken and egg kind of race to the bottom here. But if the ECB is pulling out all the stuff zero bound, they're moving deeper into negative interest rate territory. I don't think that will actually be effective. It's not been effective to this point. So that's not helpful, but to the degree that the ECB is engaging in additional quantitative easing, which we expect in September, then that should be stimulative, but the Fed has to keep up with them as well.
Kara Kadana, chief U.S. economist for Bloomberg Economics. Stay with us. We are 10 seconds away from when we expect to get Jay Powell's speech, at least the release of the text that he is delivering to Jackson Hole. And currently it is out. He is saying that the economy is in a favorable place, although it does face significant risks. So trying to thread that needle, highlighting the need for the Fed to be on high alert while also remaining confident in the U.S. economy. He said, we are carefully watching developments as we assess their implications for the U.S. outlook and the path of monetary policy. Interestingly, he said, while monetary policy is a powerful tool that works to support consumer spending, business investment, and public confidence, it cannot provide a settled rule book for international trade. Matt Boesler is over in Jackson Hole joining us now. Matt Boesler covers the economy and the Fed for us at Bloomberg News. So, Matt, what stood out to you most from the text of Fed Chair Jay Powell's speech?
Yes, so the main takeaway from Jay Powell's speech today in Jackson Hole is he's talking about the outlook for policy over the next few weeks and months. And he says that the 3 weeks since our July FOMC meeting have been eventful, beginning with the announcement of new tariffs on imports from China. He talks about the global slowdown and some of the negative data that we've gotten out of Germany and China lately, plus geopolitical events like the rising risk of a hard Brexit and tensions in Hong Kong, the dissolution of the Italian government. So you put all these things together, and I think it indicates that, just since the July FOMC meeting, they have a lot of new things on their plate to consider, and probably all of those things, point toward further easing later this year.
So, Matt, it's interesting. Do you think the Chairman Powell he really has to thread the needle here, doesn't he? Because he's got lots of cross currents ahead of him, as does the Fed Reserve overall.
Yeah, that's exactly right. So, of course, the flip side of this story, which Powell also refers to in his speech, is that, the U.S. data have been pretty strong, and we haven't really seen much deterioration in the U.S. economic data yet, outside of, a few key, admittedly, sectors like business investment and what's going on in manufacturing. But, of course, you have to balance that with, the low unemployment rate, the strong labor market data, and this conviction that inflation is still going to go back up to their 2% target. And so certainly all of the Fed speak and what we saw in the minutes on Wednesday indicated that this is still a very split committee on the need for easing at this point. And so Jay Powell's job is really to try to convey the message while keeping the committee together.
So right now we are looking at bond yields heading lower. It does appear to be perceived as a dovish Fed speech. And Dave Wilson, Bloomberg stocks editor, here in our Bloomberg 1130 studios. Let's just get a sense of the read-through right now of market reaction, because this has been perceived again as Jay Powell in some ways confirming the market view that even though things look pretty good, they are willing to act in the face of uncertainty.
Which, if you think about it, considering that China, put up those $75 billion of retaliatory tariffs, that's exactly what you would want to hear. I mean, they start kicking in next week. We'll see more of them out to December. So that's, a more direct sort of concern. And the Fed has a lot on its plate. So the idea that, they're going to move further if they need to sustain, the economic expansion. I mean, that's just really what people would want to hear at this point. I mean, I'm watching the auto stocks as an example because they took a hit right after the China move, and we're seeing those losses being trimmed. I mean, Ford and General Motors down less than 1% at this point. So, there's sort of a good sort of a litmus test, you might say, if only because the automaker is relatively sensitive to what's going on with interest rates, and that's where the Fed pops in.
So, Carl Riccadonna, Bloomberg Economics, still with us. Carl, what are your thoughts? What are your initial kind of read-through here?
Well, I think Matt Boesler hit the nail on the head in terms of pulling out the key operative line of that speech. The 3 weeks since the last FOMC meeting have been eventful. And that is Chair Powell saying basically what we had placed into the profile on July 31st. We can rip up that script, and we're now looking at a different course, which obviously is going to be a more dovish course here. So the Fed was looking at 1 or 2 cuts. Now I think this is Powell's way of signaling maybe a little bit more. And just one final thought there. President Trump earlier this morning tweeted, "Now the Fed can show their stuff." This is not the type of speech that President Trump wanted, where he would presumably want a much more aggressive Fed. So this is dovish, but not nearly as dovish as what the president wants. So I will certainly be keeping an eye on his Twitter feed and potential dissatisfaction, or maybe if it's not coming from the Fed, then he's going to get it on the tariff front.
Exactly. Carl Riccadonna, Bloomberg Economics, thanks so much for joining us for your thoughts. Right now we want to turn to Kathleen Hayes. Kathleen's a global policy and economics editor for Bloomberg News. Kathleen, love to get your initial thoughts here on the commentary from Fed Chairman Powell.
Doors still open to rate cuts. No clear sign that they're going to walk through, although Jim Bullard, President of St. Louis Fed, said earlier today that he does see the need for more cuts, and I think that's a somewhat different tone than we heard from him just a couple of weeks ago. So clearly there are some, in fact, I think he specifically mentioned the yield curve. And of course, in that key part of Jay Powell's speech where he talked about the 3 weeks. That's one of the things he mentioned, of course, is markets and market volatility. And everyone knows 30-year bond fell below 2% for the first time ever, right? It's back above. Nevertheless, I think it's also important that there's another line where he says, because he's talking about 3 phases of monetary policy. Phase 1 was several years of bringing inflation down. Phase 2, keeping rates very low, but then you had financial excesses. Phase 3 is, since the Great Recession, getting back on track, trying to keep it going. But then at some point in this final section, he throws in, I'll paraphrase, but now we're trying to set policy in the middle of a trade war. This really muddies the water so much, it makes it much more difficult. He talks about having to look down the road. Here we are now, but we have to look over the next year. Seems to me that if I'm going to say, gosh, if you ask me, Kathleen, one way or the other, do you think he's for rate cuts or not? I think he may be gently on the side of those saying, maybe one more isn't such a bad idea.
Matt, I just want to get a final thought for you. We know you have to run. You got a lot on your plate there. I'm curious about what your take is on how Jay Powell addressed trade. This has been a key issue. He acknowledged this has been a key driver in this slowdown, but also said that monetary policy, basically implying it's an imperfect tool to address it. So what's your take on that?
Kathleen nailed it. I mean, there's a big portion in Jay's speech where he talks about just the fact that, the models that they've been using to make monetary policy for the last, 30 or 40 years or so don't really have some variable for trade developments in them, right? So in that sense, this is just not something they're used to dealing with. One interesting thing I also wanted to flag from the speech that kind of gets to this is Powell also talked about how, along with July's rate cut, the shifts in the anticipated path of policy, over the remainder of the year have eased financial conditions. And he says that helps explain why the outlook for inflation and employment remains largely favorable. So he's kind of hinting that, not only the July rate cut, but also what is priced into markets for beyond is a big reason why the outlook is still favorable in their minds. And so I think that potentially constitutes another hint that, if you thought that they had to follow through on a promise of a July rate cut, that kind of thinking may still be, top of mind for them going forward over the next couple weeks and months.
Matt Boso, thank you so much for joining us. Matt from Bloomberg News, giving us his thoughts on Chairman Powell's comments from this morning. Dave Wilson, looking at the markets here, kind of they came back a little bit. We have the S&P down 5, NASDAQ down about 25, Dow down 6. So coming back a little bit. So proceed perhaps a little bit dovish coming out of the Fed, but still, you've kind of got that yin and yang of the Fed and monetary policy, but trade on the other hand, right?
You still do, no question. And, as much as bringing down interest rates would probably counter that to some extent, I mean, we won't know how much and whether it's really going to be effective for some time, especially as, the Chinese tariffs ramp up. It's going to be even more that the central bank may or may not decide to offset in terms of where they go with monetary policy. So when you put it all together, it's not like, the playing field has really changed all that much from where we've been for the last few weeks with, people anticipating that rates are going to come down multiple times and soon.
I want to bring in Bob Eisenbeis. He's vice chair and chief monetary economist at Cumberland Advisors, and also he's the former director of research at the Atlanta Fed. We're talking about Jay Powell's speech. Still with us is Kathleen Hayes, as well as Dave Wilson. Bob, I want to get your sense of the speech. Right now, it's being perceived by markets as indicating a greater willingness on the part of the Fed to cut interest rates. I'm looking right now, about 2.4 cuts now being priced into the market by year end. Do you think that this is a correct reading of Jay Powell's words?
Well, I hope it's not a correct reading, because I think that's not really the appropriate path. And one of the things I found sort of interesting is when you looked at the minutes of the last FOMC meeting, in fact, the staff had marked up growth projections in the near term and also marked up the inflation projections. And you put that together with the kind of rhetoric we heard from the interviews with several of the Reserve Bank presidents who were sort of saying now is not. Chairman Powell has a real difficult path ahead dealing with this mix of views on his committee. And I'm concerned that when you try to deal with uncertainty using policy, I don't know of any models that say that policy changes can deal with uncertainty. It can deal with risk, but it can't deal with uncertainty, because uncertainty means we don't know what's going to happen. And so it's hard to take out an insurance policy when you don't know what's going to happen.
So, Kathleen Hayes, I want to bring you back. I mean, are you surprised to the extent that Chairman Powell seems to be recognizing, kind of what is a persistent, if not growing, global trade concerns?
I'm at least a bit surprised. I don't see how he could avoid it. And I would like to throw into the mix something very interesting that Carmen Reinhart, Harvard University professor, said last night on our U.S. Asia shows when I interviewed her, that she thinks, I said, what about this concern about recession and should the Fed be preemptive? She said she thinks people are downplaying the potential of shocks, and she specifically mentioned what's going on in Hong Kong. I said, well, how would that cause a shock? Would Hong Kong lose its ground as a financial center with the Chinese government rush in aggressively? And she said, well, whatever happened, she said, shocks don't always happen with a bang; they can happen with a whimper. But there's also Brexit. We have seen all the global slowdown. I totally get. If I was on the committee, I don't know how to vote because I wait. And I think actually one of the reasons that people like Eric Rosengren want to wait is because the funds rate's barely over 2%. If they do QE, you've got a 10-year note at 1.6%, as Eric said in that interview Monday. You don't have too much to do buying bonds to push down long-term rates. They're already so low, right?
Right.
And you can't cut rates much. He didn't say that exactly, but that's what I think is part of the reason for people to say, let's don't go yet.
Well, Bob, then I want to just pivot back to you and your points, basically saying that the Fed it would not be appropriate for them to cut rates given the fact that inflation is starting to pick up and growth is strong. I'm just wondering, what is the risk of overheating here? Because a lot of people say that it is still pretty small, while the chances of a Fed error that causes the market to tank and thus send it closer to recession is much greater. Where do you weigh in on that?
Well, two things. First of all, I agree with the points that Kathleen has made, and most expansions end because of some sort of a shock. And I don't see a Fed holding off as being sort of a contributory shock that might essentially be one of those events that would lead to a recession. So I don't see policy and a policy mistake playing into that role at this point. We've got trade, we've got all these other factors that are going on, which I think, frankly, are a bit overblown when it comes to the importance of trade to our economy relative to what's going on the domestic side. So, I think that if they were to make a cut, all that's going to do is sort of call for more cuts down the road, and it's going to put them on a path where they're going to use up all their ammunition. And I think that's sort of the view that Eric Rosengren and some of the other people are on. They don't want to sort of preemptively lose control of their tools.
So, Dave Wilson, just looking at the markets here, the S&P kind of, softer again, down about 10, the Dow down 50. It looks like the market's just, a little bit, again, unsure about the ultimate path of the Federal Reserve here, not, taking, a particularly hawkish or dovish view.
It has that look to it, and at the same time, and you have so many issues in the backdrop, including the ones that were alluded to. So you put it all together, and we're kind of looking ahead and trying to kind of get a feel for how things shake out in terms of monetary policy, and it is not quite as clear cut as a lot of people would like it to be at this point, given the focus that there has been on bringing down interest rates.
Kathleen Hayes, can you just give us a sense of what the mood is like in Jackson Hole?
Well, it's hard to sum it all up, but I think everybody is really concerned about where the world is and where it's going. And one of the things I keep asking people about in interviews or just talking is, what's going on? Negative bond yields, we get more every day, right? This big drop in rates, very interesting. This is maybe a little bit nerdy, but maybe Bob Eisenbeis will appreciate this. John Lipsky, who's the former number 2 at the IMF and, was at JP Morgan as their chief economist for years, et cetera, said Stanford Institute for Economic Research came out with a speech this week, a research piece, arguing that because of technology, that inflation is even not higher than we think, but much lower than we think. And if that's the case, real interest rates are higher. And so in that context, maybe lower yields make sense. Jacob Frankel, JP Morgan Chase International, former head of the Bank of Israel, et cetera, is concerned. He thinks negative yields are a bad sign. He thinks they kind of blunt the transmission of easy policy through the financial system because it's hard for banks to pass it on. So there's definitely concern here. And people, I think a lot of people feel too like, what? The Fed doesn't have any better idea than anybody else of where we are and where to go next. They're just going to do the best they can and hope it works.
Kathleen Hayes, thank you so much for joining us. Kathleen's global policy and economics editor for Bloomberg News and Bloomberg Television. Bob, just want to get one more thought from you. I mean, it's clear that Chairman Powell and the Fed are concerned about global trade. But, boy, we got some weak numbers out of Germany earlier this week. That's got to be an issue.
Well, it is. It's a big issue for Germany and for Europe as a whole because they're going to be really suffering as we see the Chinese reimposing some of the tariffs, particularly on autos, when you consider how much of the German autos are made here in the United States, which would ultimately be exported to China. So, they're deeply entwined across the whole global environment, and that is not without consequences when you have these kinds of trade wars going on. And it turns out they're not so easy to win.
Bob Eisenbeis, Vice Chair and Chief Monetary Economist at Cumberland Advisors, as well as the former Director of Research at the Atlanta Fed. Thank you so much for being with us. Dave Wilson, Bloomberg Stocks Editor, thank you so much also for joining us and giving us the view from the markets desk, and we will be getting more from you later on. Right now, let's get a check on what's going on outside of the Fed. We have Doug Krisner. Doug.
Hey, Lisa, a little bit of weakness in the equity market, but we are off session lows. NASDAQ composite down about 0.4%. You guys have been talking about China launching retaliatory tariffs on another $75 billion in U.S. goods. And at the same time, Fed Chair Jay Powell addressing the Fed's Jackson Hole Symposium. In prepared remarks, the Fed Chair said the economy is in a favorable place, but does face significant risk as growth abroad slows, and we've got a lot of trade uncertainty. Earlier, CNBC was saying the White House has discussed a Fed governor rotation to curb Fed Chair Jay Powell's power. U.S. 10-year Treasury right now yielding 158, seeing a lot of weakness in WTI crude oil, down about 2% right now, 54.27. S&P 500 being led lower by consumer discretionary names. The S&P down 0.2%. For the Dow, a loss of just 0.1%. I'm Doug Krisner. That is your Bloomberg Business Flash.
This is Bloomberg Markets with Lisa Abramowitz and Paul Sweeney on Bloomberg Radio.
Well, certainly a busy morning for the markets. Lots of information to digest. We have tariffs coming out of China. We have Fed Chairman Powell with his commentaries on the economy and Fed outlook. To get some color, we welcome our next guest, Jason Pride. Jason's the Chief Investment Officer of Private Wealth at Glenmead. Jason, just wonder, let's start off first. You've had all of a few minutes to digest kind of what we've had from Chairman Powell. What was your take on kind of what we heard from the chairman?
Look, I actually kind of looked at the speech and I thought this was a pretty good speech that is going to be coming from the chairman. It's a hands on the wheel sort of speech, not a where we have our hands off the wheel that we don't know what's going on. It's a we are monitoring it. We have our hands on the wheel. We are trying to assess the situation and things are changing sort of speech. And also it's a speech that gives a lot of historical context as to what the downsides are to further rate cuts, which was kind of interesting if you actually dug through the speech that's coming out. I think it hints towards more rate cuts, but it doesn't put a definitive nail down or statement down that we're going to definitely be doing 50 or 75 or 100 basis points in additional rate cuts. But it leaves that door open and makes it very clear as to why they may be hesitating or why they may not be saying exactly what they're doing on a go-forward basis, but giving an idea that they are going to be reacting appropriately to the environment as it unfolds.
Jason, one question we continue to ask people has been, are you trading on these headlines? And we see market moves, and every real money investor who we speak to says, we are not trading on them. We're waiting for something concrete to happen that really is a catalyst, and we're doing fundamental research, and we're real money investors. Do you find that you are advising against trading frequently and just sort of taking a long view, or is this a tradable opportunity, some of these headlines?
Well, I'm going to give you a horrible answer here. I'm going to give you a yes and no answer to that, right? So the no answer to it is that we're not making big macro trades on this basis because we see this, there's a lot of kind of shifting sands on the macro basis in terms of what's going on. And our models, our view of it hasn't changed that much. We think there's somewhere in the ballpark of a 15% to 20% probability of recession. It's not an over 50% chance. There's some risk of it, but the base case is still the base case that was in place before. So the macro sense is still kind of the same story. Now that means rebalancing a little bit, and that's why my yes answer is also there. Is there's a little bit of rebalancing of portfolios in the adjustment. As markets back off, we need a little bit more equities and we need to come back in. As markets rise, we actually take a little bit off the top. The other part of that answer is not all the pieces are moving at the same time in the same direction. And these sort of dislocations and volatility provide opportunity at the security specific level. And we're trying to take advantage of that along the way. A couple of things that come to mind is just
lower capitalization issues have been performing considerably more poorly than larger capitalization issues throughout this entire time frame. And we're looking to kind of occasionally find good opportunities in the smaller capitalization and even mid-capitalization space of the equity markets as the markets get dislocated here and there, number one. And number two is we've actually been a long-term fan of Asian EM markets. This has been a very specific attack on them from policy, and it provides an opportunity for investors to gain a little bit more exposure in what is a very long-term trade or long-term investment on the rising EM consumer.
So, it's interesting you talk about the emerging markets because obviously it's a hard way to play it. We had a strategist in here earlier just saying, boy, unfortunately, there's not a lot he can talk about on EM stuff because it's just been, kind of really been hurt and it's been an underperforming asset class for a while. Mm-hmm. So what is your fundamental view that, just that part of the world, and you think about some of the long-term macro trends, whether it's populations or incomes and things like that, that's the play, and the short-term trade issues be damned?
It's a huge play, and it's a huge play that I think we discount way too much. To give you an idea of the context or the size magnitude here, there are just as many people population-wise living within the Asian region as there are the rest of the world. Yet the aggregate income there is still in the ballpark of 1/10 to 1/15 in terms of GDP per capita in those regions. And it's been rising faster than anywhere else, partly because policies are being put in place, income is being shared by corporations to the consumers. Their wages are growing 5 to 10% per year. And big surprise, just like us, what do they do when they make more money? They turn around and spend more money. So there's a huge consumer market there. We're not a big fan of investing in that region or to invest in exporters back to the U.S. That's the specific target of the trade actions. We're more invested in things that are being delivered to that consumer base that actually ends up being a little bit more insulated from the trade situation. The problem is the markets don't really differentiate during these environments between these two things. They sell the whole basket together at the same time, and those things are actually good long-term investments, get sold off right alongside the things that are the exporters into the regions that are being hit by the trade policy changes.
Jason Pratt, thank you so much for being with us today. Jason Pratt is Director of Investment Strategy at Glenmead, overseeing $25 billion from Philadelphia, but he's joining us here in our Bloomberg Interactive Brokers studios. Just about an hour into the trading session, and it is risk off, although it's being buffeted, the markets, by both the trade headlines coming out of China saying that they're going to impose additional tariffs to retaliate against the United States, as well as a dovish tone from Fed Chair Powell. Traders trying to make sense of it as we await more insights. President Trump tweeting to the Federal Reserve, let the Fed show us their stuff in response to what has been going on from China.
Now, we haven't seen a tweet after, have we?
We have not seen a tweet after, but we will continue to follow that. I'm Lisa Abramowitz alongside my co-host and colleague Paul Sweeney from New York. This is Bloomberg Markets on Fed Day Friday.
This is the Bloomberg Market Minute. Federal Reserve Chair Jay Powell said the U.S. economy is in a favorable place but faces significant risks as growth abroad slows on trade uncertainty. That's in remarks to central bankers gathered at the Federal Reserve's annual symposium in Jackson Hole, Wyoming. Stocks pared its losses and are now little changed after he said the Fed will act as appropriate to sustain the expansion. Equities dropped earlier after China hit back at the U.S. with tariffs on $75 billion of imports, deepening the trade dispute that jeopardizes the global economy. Gap reported another quarter of declining sales at its namesake brand in Old Navy. Same-store sales fell 4% at the overall company in the second quarter, which was worse than expected. Old Navy, which generates close to half the company's revenue, reported that comp sales declined 5%. And next Monday, a new menu item at KFC. The Yum Brands division is introducing mac and cheese bowls. The dish will be topped with crispy popcorn chicken. Courtney Donahoe, Bloomberg Radio.
Sweet strawberry icing. You're in Goodwill, and just past that vintage denim jacket you spot miniature donut earrings. You lean in. Ah, that's the scent of shopping success. Because at Goodwill, every item you buy funds local job training and more. So bring home those donut earrings and bring home so much good to your community. Goodwill. Bring good home. Brought to you by Goodwill and the Ad Council.
economics.
Are we still ultra-accommodative?
Finance.
Do you see this as a technical correction?
Investment.
The markets move seismically.
The Bloomberg Surveillance Podcast.
Mistakes are made when you sell something because you need to sell it.
Tom Keene, Jonathan Perrow, and the names that shape the world's markets.
We speak with Professor Schiller of Yale University.
An exclusive interview with the UK Prime Minister Theresa May.
Bloomberg Surveillance. Listen today on Bloomberg.com, the Bloomberg Business app, or subscribe on Apple Podcasts.
Are you? This is a plug. A plug for the future. Inviting you to join the forward-thinking riders, skaters, and drivers who choose electricity to get around. Charging their bikes, boards, and cars using power from EDF Energy, the UK's largest producer of low-carbon electricity. So, do you like the sound of the electric future? Come and join us. Generation Electric. Everyone's welcome. EDF Energy.
Live big and spend less on the brands you adore. And dine by the waterside. Who could want more? Lap up the savings as much as the view. With Ted Baker, Hackett, Nike, and Coach too. Lock Fine and Five Guys make it a date. You can shop, meet, and eat every weekday till late. So sit back, unwind, and let style lead the way. And give yourself a different day at Gunwharf Keys. Waterfront outlet shopping.
Did you know Currys PC World do business, saving your business up to 30% with mega deals on computers and printers, electricals, large screen TVs, and more. Top brands like HP, Microsoft, Epson, and Sony, and even more. If you find it cheaper from any major retailer, we'll match it.